the selling triggering stops made the market collapse. This isn't conspiracy. Read the executive order that next year they're talking about revaluing gold as part of the Bitcoin fund that Senator Lummis from Wyoming has been advocating for. And if they do revalue it, it devalues the dollar. It's not about revaluing gold. It's about devaluing the dollar to a much lower level so we can sell our products to the world. You have to bring back manufacturing. How do you do that? You peg gold to the back end of the bond market and you end up having zero upfront borrowing costs. Like in the Shawshank Redemption, there's 2 miles of shit that we have to crawl through to get to the other side, like Andy Dufresne did. And that's what happens with the irresponsible fiscal policy that we've had and the brain-dead monetary policy we've had for all these years.
Something strange is happening in the gold and silver markets right now. And it's not just another correction. In the dead of night, when global trading desks were asleep, billions of dollars worth of gold and silver contracts were suddenly dumped into the market. Prices crashed, stop-loss orders triggered, and the headlines came fast. Gold overheated, silver correction begins, investors take profits. But according to precious metals expert Andy Schectman, this wasn't natural market behavior. This was a coordinated attack by the world's biggest bullion banks, a deliberate effort to crush sentiment and defend the paper-based dollar system against a global surge in physical demand. He believes the so-called correction is actually a controlled suppression designed to protect a financial order that's running out of real metal. And the truth, he says, is simple. They're not trying to revalue gold upward. They're trying to devalue the dollar downward. In this episode, we're breaking down what really happened, how the bullion banks are manipulating prices in plain sight, and why Andy Schectman believes this is the clearest signal yet that the era of paper money is ending.
When you look at it from the mainstream perspective, yes, much of what they said was valid. It had gone up, really unencumbered for 9 straight weeks. It was overbought. All of that's valid. All of that's true. It had busted through well in excess of moving averages, the 50, the 200. All that's true. It was ripe for a correction and a flush and a pullback, and all of that is true. And if it had been said that way, of course, they always throw in, is this the top, the 2011-1980 top, where it starts to head down and maybe, this is it, maybe look for other assets, Bitcoin or whatever the hell you want to talk about it. Look, if they would have just told the other half of the story, I would have been more inclined to acquiesce to some of their validation or to some of the things that are valid. I think by not telling the whole story, it invalidates much of what they say. The initial snowball that was pushed down the hill was in the middle of the evening after all of the markets had closed and the New York traders were in bed, and it was sold in the access market, it being gold and silver, billions of dollars worth, in the middle of the evening when there's no liquidity, when the markets aren't there to catch the bids, and instead the driving down of the price, dumping it onto the market at strange hours. When it started, it was in the middle of the night. I don't remember exactly what time. And then the next day they did it like 8 or 9 o'clock at night, when in between New York and Asia. Again, New York's closed, Asia hadn't opened yet. You see a price that's getting clobbered because all that does is hit the sell stops that are embedded in algorithmic programs along the way, and they drive the price down. In other words, this was done as a drive-by shooting for an effect. There would not be a trader on the planet with a third of a brain cell that would dump all of this at a time outside of New York trading, where that's where the price is set. That's where the bids would be. They would do it slowly and judiciously over time, even a matter of days, that amount, slowly, without alerting or waking everyone up to a dumping of metal. And they would catch all of the demand for 9 straight weeks that have been growing up. They would have got a much better settlement. In fact, they guaranteed themselves the absolute worst settlement. And so the selling triggering stops made the market collapse. Now, what they also didn't talk about, and let's just stop right there for a moment. If they would have said all of those things, market's overbought, gone up for 9 straight weeks, the technicals said this is ripe for a correction, for a flush, for a pullback, whatever validation they want to attach to it, It's invalidated by not saying, by the way, some idiot dumped it in the middle of the night when there was no liquidity in the market and there were no traders, and this is done in the access market. Nobody would do that. They conveniently leave that part out. The other part that they left out was the second day when it was done in between New York and Asia. Again, equally a stupid time to do it. Within just a few minutes, the silver price shot right back up. Well, how the hell did that happen? Well, if you look at Michael Lynch, and he does an amazing job at analyzing the COMEX movements, he says that it was Bank of America and Morgan Stanley that came in and did the purchasing. It was European banks that did the selling, and it's commercial banks, and it was Morgan Stanley that came in and did the buying. Well, why is that valid? Well, the chief investment officer of Morgan Stanley recently came out and said the 60-40 rule of investing that Wall Street's used for, I don't know, 50 plus years was invalidated now by
60-20-20.
Yes. In other words, sell half your bonds and put 20% into gold. And then that's Morgan Stanley. And then Michael Hartnett, the chief head analyst for Bank of America, says no, 25, 25, 25, 25. 25 stock, 25 bond, 25 short-term treasuries, 25 gold. And I mean, in my whole career, I've been 35 years, they've never said that at all, ever.
Andy Schectman starts by explaining exactly how the price crash unfolded. Massive gold and silver sell orders hit the markets during the most illiquid trading hours, after New York had closed and before Asia opened. That timing wasn't random. It guaranteed minimal buyers, maximum impact, and complete chaos. The result? A wave of algorithmic selling, panic liquidations, and a cascading collapse that sent both metals plunging in minutes. To the untrained eye, it looked like a natural pullback after a strong rally. But to seasoned traders, it was obvious manipulation. No professional would ever dump billions at a time when there's no liquidity, unless the goal was to force a collapse, not to trade efficiently. And what happened next confirmed it. Within hours of the smash, major U.S. banks stepped in and bought the dip. Schectman points out that while European institutions were dumping, Wall Street's biggest names were quietly accumulating physical and paper exposure at fire sale prices. It's no coincidence that those same banks have recently shifted their guidance, recommending investors hold 20 to 25% of their portfolios in gold. After decades of ignoring the metal, they're suddenly loading up while everyone else is scared out. Meanwhile, the structural cracks in the global bullion system are widening. The LBMA in London is bleeding metal to Asia, with backwardation returning, meaning physical gold is now worth more than future delivery contracts. That's an unmistakable sign of shortage and stress. In the U.S., the COMEX continues to see record physical deliveries, even in non-delivery months. Sovereign wealth funds, BRICS nations, and even American entities are standing for delivery, quietly draining inventories. Silver's situation looks even tighter. With Washington officially classifying it as a critical mineral, industrial demand is exploding while supply keeps shrinking. Yet the price remains capped, a sign, Schectman says, that the paper market is doing everything it can to hide reality. He warns that this kind of midnight dumping isn't just about short-term price action. It's a last-ditch defense by bullion banks caught massively short. They're fighting to maintain control as physical demand overwhelms the paper system. And here's where it gets bigger. Schectman believes the U.S. is already preparing for a monetary reset. Policymakers are quietly discussing revaluing gold to strengthen America's manufacturing base by devaluing the dollar, effectively pegging gold to the bond market and making exports cheaper. In his words, they're not revaluing gold up, they're devaluing the dollar down. This, he argues, is the only way out of decades of reckless fiscal policy and unsustainable debt. The gold market manipulation isn't a conspiracy. It's a sign that the system is trying to buy time before the reset hits.
Yeah. Maybe 5%, they would say. So the two American banks that are saying 20 to 25% allocation come in and do the buying, according to Michael Lynch, and he's got a great Substack. People should check it out. So when we talk about this, the fundamentals are fugazi. The fundamentals are strong as hell. The LBMA is being bled down. I did an interview with Alistair McLeod this morning, and Alistair's like, yeah, I see this morning that the Backwardation is slight backwardation is reappearing between London and the US again. So all the metal that got shipped from Shanghai at exorbitant lease rates and whatever 20 or 30 million ounces that got shipped from COMEX over there to quell the problem. Well, what good did that do? There's still deliveries next month and the month after and the month after. And so the physical demand is overwhelming the paper price. And it's desperation when you come in the middle of the night and dump at a time that no one would do it. It was specifically done to cover shorts and for effect, and for the media to jump on and tell half the story without saying, by the way, some idiot dumped it when no one else ever would, to maximize the worst possible settlement they could ever get. And so that to me invalidates so much of what would otherwise be valid statements. And I think it goes to show where silver is ultimately going when the U.S. government has proposed and written into draft, and it will be accepted, that silver will become a critical mineral in this country. Things are changing, and I think what we saw was a desperate attempt by some really caught commercial banks that are massively short, and the rising price, coupled with a government shutdown and trade meetings with Xi and all sorts of stuff going on. The last thing, and interest rates going to be lowered again. The last thing they wanted is for metal to get way out of control, and this is their way to stop it. But I would argue only temporarily. I started coming on your show way back when at the beginning. I was talking about all the deliveries that were coming off of COMEX. And it was very unusual starting in 2020 because no one ever stood for delivery. The exploitation of the delivery option in London and the US is something that was rarely exploited, and now it's being exploited not only by all of the BRICS nations and Russia and China and India and Saudi Arabia and all of the countries that are standing for delivery on all of the world's commodities, but there's someone got to President Trump, in my opinion, and said, if we don't do this, we're dead. We're dead, because they're draining the shelves across the globe. And so they phrase it as tariffs, and they start bringing it back. It's not tariffs, it's reshoring. All the gold and silver, billions and billions and billions and billions and billions of dollars worth of metal. So far this month, which is a non-delivery month in silver, just shy of 8,000 contracts have stood for delivery already, at 5,000 ounces apiece. So do the math. I mean, it's not a delivery month, but it's still an awful lot of silver.
Yeah, it's a lot.
And yes, it is harder, because if in a game that is just cash settled amongst coordinated players across the globe, it's easy to suppress the price. But when all of a sudden you are being challenged not only by central banks and sovereign wealth funds across the globe, but now a large, what appears to be entity here in the United States who are literally bringing in billions of dollars a month in silver onto COMEX, something's different. And you can only manipulate a market over time by pushing the direction it's going. And it was easy to do that for a long time. The fact that they are standing for delivery slowly, not so fast to break the system like we're close to seeing in London, but slow enough to bleed it all dry. And that's why I would argue that some of the metal flowed back there reluctantly, because this is how they have been bleeding down the system for the last 5 years, by slowly off-taking as much as they could out of London. And that's why London has the lowest float that they've had basically ever since they started keeping records, about 140 or 50 million ounces against 600 million ounces a day in trading. So what could possibly go wrong? And so they are standing for delivery. This is showing the cracks, and that's why we had $3 an ounce backwardation for a while, where the physical metal right now today is worth more than the futures price, and that's very rare in the commodity complex.
So, let's ask the hard question. Is this just a normal correction before the next rally, or is it the calm before a massive monetary reset? If the world's biggest banks are fighting this hard to suppress metals, what are they really afraid of? And if physical deliveries keep rising while available, inventories keep shrinking, how long can the paper system survive before breaking completely? Andy Schectman's message to gold and silver investors is crystal clear. Every time they push prices down, it's an opportunity, not a setback. Every manipulated dip gives real stackers a chance to accumulate tangible wealth before the system reprices everything. He reminds investors that this isn't about quick profits. It's about positioning yourself for when the illusion ends, when paper promises fail, and only physical assets hold real value. So now, it's your move. Do you believe this is just consolidation before the next breakout, or the beginning of a global currency revaluation? How high do you see gold and silver going by the end of the year? Drop your thoughts in the comments below. I want to hear from every serious stacker watching this. And if you found this analysis helpful, hit that like button, share this video, and subscribe to stay ahead of the unfolding reset, right here on Macro Edge. Because in a world built on paper promises, knowledge and real metal are your best defense.